And it sounds like Biden is making that point. $400,000 is this is rich. 400,000 and up. What say you?
Well, I wish there was a way to adjust it for geography.
Come on. Okay. So this is from CNBC.
Wait, hold on. What?
Well, I'm just going to lay it out. So $400,000 in income represents the top 1.8% of taxpayers.
Okay.
That's about 25% of the income.
Okay.
I don't think we need to put context and perspective about that. If you make $400,000 a year or more, you're making a lot of money. You're wealthy.
That I don't disagree.
Okay. So I don't know. I don't see how you could change it for living standards and all that stuff.
No,
I know
here's
that
what I'm saying. Because if you make
you're just a coastal elitist.
If you make $150,000 in Boise, I want you to pay more taxes. Damn it.
Okay. Well, yeah, I get it because in New York you're paying way more taxes than I am in Michigan or whatever.
But no, I don't disagree. That's a shitload of money. So, but all right, I think most people know this, but this is a marginal tax increase, meaning you're only going to see a slight increase on income above $400,000. So Seth Hanlon, a senior fellow at the Center for American Progress, said people making between $400,000 and $700,000 are going to have a tax increase of only about 1% or less. This tax plan is really aimed at the very top, the top 1% or 0.1%.
And this hasn't happened yet. This is just still in the planning stages.
So you know that chart from Financial Samurai who's like, if you make $400,000 and you spend all of it, you have no money left. I mean, that's basically what that chart is. So you've seen this before, but every time it pisses people off, myself included. Based on the expenses, a $400,000 household income provides for a relatively middle-class lifestyle. A middle-class lifestyle is defined as owning a home, having 2 kids, saving for retirement, saving for college, going on modest vacations several weeks a year. Give me a fucking break. Vacation several weeks a year. Who does that? Honestly.
Right. Yeah. That's a pretty good lifestyle.
Who does that?
That's upper. I know.
So they're also talking about a $2 million house. Yeah, that's middle class. Where? And I had some people like actually he's not so far off, which is like I make a lot of money without saying I make a lot of money. But give me a break.
Yes. I don't care where you live. That's a lot of money. And guess what? Back to the remote work stuff. If you make that much money, go move somewhere else if you're living in that expensive of an area.
This is so great.
Think about it.
They only have about $34 left at the end of the year as extra cash flow once their household expenses are paid.
Here's where I agree with them. I do think you should look at your savings like a bill. Okay? I've said that before, but really that's not that's not a bill. That's savings.
After your savings, your income should you should have zero left over after your savings and spending. I completely agree. All right, I want to talk about Stephanie Kelton. She wrote the book The Deficit Myth, which Ben and I read, and I am sympathetic to a lot of that stuff. She was on the Odd Lots podcast with Weisenthal and Tracy Alloway. And I wonder if the people that are really angry have ever even listened to her or read her stuff, because she's very reasonable. She's not saying spend and keep spending and nothing matters. But she said, we have asked central banks for too long to do too much. And don't you think everybody would agree with that? She's basically saying that fiscal policy needs to come to the forefront. And her biggest point is that budgets are not the constraint, inflation is. So why do we need taxes? Well, because if there was no tax, there would be rampant inflation. There would be way too much money in the system. It's a way to regulate inflation. So I think looking at the political choices through this framework, through this lens, will lead to much healthier debates about what we can and can't spend money on.
I've gotten a surprising number of emails from people who have said, you know what? I was never a fan of the MMT stuff, but I read her book and it actually makes more sense than I thought. I've received that same email multiple times.
Yeah, she's not saying spending doesn't matter. She's just saying the framework that we've talked about in the past is just bullshit. It is.
And the biggest drum and argument for this is, okay, we're going to give people $2,000. Why not give them $100,000?
Because inflation.
That's the dumbest.
Because inflation.
Yes, and she says, listen, every one of these spending bills should be looked at in terms of, what is this going to help? What is it going to... And I think the people who are the angriest at the Fed for propping up asset prices and punishing savers and all this stuff, they should be happy that we're spending more fiscal policy, because you can see...
We're taking power away from the Fed.
It does, and it does flow through more to more households, more middle-income households that need the help, and lower-income households that need the help, as opposed to the Fed basically having one hand tied behind their back, and the only tools they can use are bailouts and helping the credit system function more fluently and lowering interest rates, which doesn't do anything for most Americans.
Here was another thing she spoke about. If we're going to do like an infrastructure project, well, we shouldn't just like do it and forget about it. Like we should prod. If we're talking to Caterpillar about building machinery, we should see what their inventory is like, what their supply is like. Can they handle this? Will this amount of spending and orders lead to inflation and pricing pressure?
Right. Will there be enough construction workers that can help make this project a thing? Yeah, she's more thoughtful than people give credit for in terms of just spend and then it doesn't matter.
Yeah, so the people dunking, idea. I mean, come on. Like I hate, read a book. Read her book. Like before you get angry, just read her book. I think that a lot of what people think she says is misrepresenting what she's actually saying. You know what she's not saying? She's not saying that there's a 30% chance of inflation or 30% chance of deflation and a 40% chance of, I don't know, what did Larry Summers say?
I don't know. Isn't it just perfect, though, that him and the Winklevoss twins in the Social Network movie, like they had their little, like, don't they just deserve each other? All Larry Summers and the Winklevoss twins.
If you started inflation, you would have started inflation.
I wish he would have just said 40% chance of everything. There's a 40% chance of hyper deflation and hyperinflation. I know that I think he's really angry he didn't get a job at the Fed and now he just trolls people. I think that's the only thing I can come up with.
All right, wild chart from Ben Johnson. With just over a week left in Q1, ETF flows are on pace to double their prior Q1 record set in 2017. This is wow. So where did this money come from? I mean, I think I have an answer, but where do you think it came from?
What's your answer?
The Fed. No, I'm just kidding. I think where it always comes from, actively managed mutual funds.
Yeah. So is this another case of the pandemic pushing people out? And obviously in 2020, it fell a little bit where people said, all right, we've got this regime change. Let's do it. Hit the switch. I mean, isn't it kind of crazy that for individual investors, 2020 was probably the easiest environment you could possibly come up with to outperform? And actively managed funds still underperformed? Like, do you think that's the point where people go, oh, wait, my Robinhood account crushed my 401k actively managed fund. Why do I have money in this anymore? Some of that, do you think some of that where like you see individuals outperforming from these stock picks that seem so obvious in hindsight, and then you look at the Wall Street actively managed firms and they can't outperform?
Balchunas really nailed this, right? He said like every time there's a bear market, the flows are going to get worse.
Yeah, it's not going to get better.
From active to passive. All right, this is David Schawel tweeted this. I don't know where this chart came from. It's I'm trying not to over-exaggerate. This is truly one of the most visually stunning charts I've seen in a long time. It's showing fixed income issuance going back to...
You're going to buy this as an NFT, aren't you?
That's a great idea.
If this was an NFT, you would buy it.
Yeah, I would. I want this. I want this in my wallet. So I mean, you can't see it now, but we'll link to this in the show notes. It's a nice segue to let's talk about Ray Dalio. He wrote an article. He wrote a book.
Wait, you didn't explain what this chart is.
Oh, I thought I did. I'm sorry. It's showing an explosion of fixed income issuance in 2020. I mean, an explosion everywhere. Corporate bonds, mortgage-backed securities, treasuries, everything.
I think this is the piece that people miss when they talk about government debt. Sometimes people don't realize that government debt on the one side is an asset for someone else. So if the government is issuing debt, they're creating assets for investors. And obviously, it's not just the Fed buying these. Investors are buying these. Insurance companies and pensions and sovereign wealth funds and individuals are buying these bonds, even though the yields are so low. People are holding these bonds still.
Yeah. All right. So here's a quote from Ray Dalio's blog. There is now over $75 trillion of U.S. debt assets of varying maturities, which absolutely contextless. That sounds staggering, $75 trillion. But to your point, that's an asset for somebody. He wrote, I know this all sounds crazy to you. Oh, he's basically saying like what happens when everybody goes to sell type of thing. I know this all sounds crazy to you. It sounds pretty crazy to me too. Who would play Ray Dalio in a movie?
I don't know.
Kevin Spacey? He's canceled, but... All right, let me just finish this quote. He said, it sounds pretty crazy.
I could see Liam Neeson as Ray Dalio.
Oh, that's a good call. Tall. I know this all sounds crazy to you. It sounds pretty crazy to me too. However, last thing, the movie would obviously be called 1937. I know this all sounds crazy to you. It sounds pretty crazy to me too. However, I have seen this confluence of circumstances leading to this sort of dynamic many times in my study of markets and economies over the last several hundred years, and I experienced this dynamic myself. Not everybody. I'm sorry. There's a chart from the Wall Street Journal showing ownership share of U.S. Treasury securities for the two largest holders, foreign investors and the Fed. Foreign investors have been not dumping, but their percentage of ownership went from, and maybe this is this may be because of all the bond issuance that the Fed is buying, but it went from 40%, over 40% down to below 30%. And the bond market has not gone kablooey just yet.
All right, remember when everyone's worried that what if China sells other treasuries? What's going to happen?
They have, literally. There's a chart. Right. I saw that chart a few months ago. Not all their treasuries, but they're selling.
Guess what? Someone's going to buy them. That's what'll happen. Right? Even at low yields. Someone is going to own bonds. That's just the way it is.
So that's it? Somebody else will buy them? I guess you're right. No, what happens what happens when they go to sell? There'll be buyers. That's what's going to happen. Next.
Yes, and if I think in such a low rate world, it's not going to make any sense, but people are going to see, well, wait, Japan has a negative 1% yield, and other places in Europe have a 0% yield, and the U.S. is yielding 2%. I'm buying in the U.S. in 2%, right? It's going to be a relative thing and not an absolute thing.
So you wrote a post about Dalio, which I didn't get to, but he's basically this is the lens through which he sees the world. Was that basically the gist of it?
Someone asked me, like, Dalio seems very pessimistic about the future, and I said maybe he's just. I looked at all these instances where he said he's written about this. In 1981 and 82, he was pounding the table that we were going to go into a depression. And he said that when like the Mexico defaulted on its debt in 82, he was like pounding the table and telling all these TV shows and newspapers that we're going into a depression. Obviously, that was the start of one of the biggest booms in history. And then in 1990s, he was interviewed, and it's kind of funny. It was in 92, and that's before the 90s really took off. People think that the 90s were just this, you knew that was going to happen because of the internet and stuff. It wasn't. At the time, he was saying this is a reverse of the 50s, and bonds are going to crush stocks over the rest of the decade. And from that point on, over the rest of the decade, stocks were up like 300%. 2015, he warned about this 1937 thing. He's done it again every year since then. Maybe he's just predisposed to have these worries because he runs a hedge fund. Maybe that's good marketing. Maybe it's his personality.
I think it's his personality. He's been very candid about his, on a podcast with Barry a few years ago, he was very open and honest about the bad calls that he's had in the past, which is why they do quantitative stuff.
So he told us to Ackman at a conference in 2015, I found. He said 99% of the time he agrees with his quantitative strategy, and the 1% of the time he disagrees, he realizes in retrospect the machine was right 2/3 of the time.
There you go.
So that's the thing. He, maybe it is marketing, or he just wants to, like, it's so funny. Matt Levine had this thing where he said that, like...
But how is it marketing? What is he marketing? They're the biggest hedge fund in the world.
There's always more people to bring. I don't know.
But I think he's just
why does he have a blog at LinkedIn? Because you can never have enough power. I don't know.
I don't think it's that. I don't like. I think he just, because he loves the markets the same way that we do, and he likes to share his opinions. I don't think it's like marketing. True. He's right.
Yeah. No. Yeah. Yeah. I guess you're right. It's part. He just likes the game.
Yeah.
Especially when he had that much money. Yeah. I totally get it. Okay. So this is from Mark Hulbert at MarketWatch, and he asks, like, he goes through line by line why market valuations are higher. This is stuff we've talked about for a while now. Interest rates are low. You have these high intangible assets, and it's harder to calculate book value. There's more buybacks than ever. You have this shifting definition of profits, like accounting changes that they made, and then you have globalization, which is fine. So all these things, we've talked about all these for years. Like this, in a lot of ways, it makes sense that valuations are high. He says, regardless of the individual merits of these theoretical arguments for why valuations should be higher now than a century ago, you can't use those arguments to conclude that the current market is not overvalued. So even though he makes these arguments, he's still pretty sure markets have to be overvalued. Here's what I want to say. Is the term fair value one of the worst terms in all of finance?
Hate it.
I mean, and is there a difference between this is certainly overvalued and this is very pricey? Right? Like,
when something gets to fair value, does it stop trading? I've arrived. Yeah. I'm at fair value.
I don't know. I guess I look at it as there's been so many changes in the way that we do things that I think it's become harder than ever to come up with any reasonable estimate of what that could ever be. Okay, real quick. I want to throw out a new theory for you. So people were getting their stimulus checks, and oh, by the way, Robinhood decided to offer bonuses for new deposits right as those stimulus checks were hitting.
Great coincidence.
Can you imagine the coincidence? Here's what I want to say. Not everyone has access to a 401k. What if Robinhood or some of these other brokerages know how lucrative it can be to trade off to sell your order flow, and they start matching like a 401k. If you do $1,000 deposit every month, we'll give you 2%. If you do $500 a month, we'll give you 1%. Whatever it is. Couldn't you see that heating up where you have these places that are fighting for money so bad from these new traders and retail people that they effectively become the 401ks as a way to induce people to come in? Could that happen? All right. I'm putting that down. Timestamp it. All right. Survey of the week. What do you got?
All right. There's a book I'm reading. I saw Wes or Meb tweet about this. This guy, Herman Poncer, was on a podcast I listened to, and then I bought his book. The book is called Burn. New research blows the lid off how we really burn calories, lose weight, and stay healthy. And Ben, I don't know if you could tell, but I'm trying to do all those things.
Are you becoming a fitness influencer? Is that what happened to you in the pandemic?
This is you're watching my transition in real time.
All right.
All right. Get this. Where does 2,000 calories a day come from? A survey. I kid you not. It turns out people are shockingly bad at keeping track of what they eat. When you give someone a dietary recall survey and ask them about their diet, the answers aren't reliable. Oh, who would have thought? It's like asking people how many times they've had impure thoughts about Brad Pitt. Everyone underreports. In a recent study, okay. In a recent study,
guilty.
You are a big Legends of the Fall guy. In a recent study of 324 men and women across 5 countries, adults underreported actual food intake by 29% on average. That's the equivalent of forgetting an entire meal every day. Reported energy intake didn't track expenditure whatsoever. Diet surveys are just random number generators, and the data they provide on daily caloric consumption are so useless. The only way to make them worse than useless is to treat them like real data and base a nutritional program on them. So, in 1990, the US FDA based the nation's public nutrition program on diet surveys. New regulations were being implemented that would require nutritional labels on food packaging, and the FDA wanted some benchmark for daily energy intake to include on the labels. Using surveys from massive National Health and Nutrition Examination Survey, they found that women reported food intakes of about 1,600 to 2,200 calories per day, while men reported 2,000 to 3,000. That would leave a rough average for all adults of somewhere between 2,000 and 2,500. To discourage overconsumption and to have a nice round number to work with, they rounded down to 2,000, and that's the number that stuck. Ben, I rest my case. Anti-survey.
That's a good one. If I ever had to have a diet where I had to count calories, I'd be out day one. That's too much of a pain. That's like penny pinching to save money every month. I couldn't do it.
I tried once or twice. It didn't.
No way.
It didn't take. All right. I want to talk about electric vehicles for a second. Rob Arnott and many others, I'm not pointing fingers, I probably nodded my head when I was reading his pieces, has been in the Tesla is a bubble camp for not that long, but a lot of percent given how fast Tesla's rise has been. So they wrote a post in 2018. Yes, it's a bubble. So what? Do you remember reading this?
Yeah, at the time. So
the price then was $50 a share split adjusted. Today it's $6.75. It was as high as $9.10. So if they thought it was a bubble at 50, then what did they think the real price, fair value was? I don't know, 15? To get back to 50 when they first called it a bubble, it would need to fall 95%.
That's why, isn't it weird to think that in a lot of ways Tesla was a contrarian play? Even though it was this high-flying momentum growth stock, so many people did not believe in this stock and were calling it a bubble a long, long time ago that it almost was a contrarian play at one point.
So they're out with a new one, Big Market Delusions, electric vehicles. They wrote, like airlines, the auto industry has historically been a competitive, capital-intensive business. For this reason, despite the global demand for their products, the traditional major auto manufacturers have tended on average to trade at book-to-market ratios near or below 1. From an industry perspective, we have little reason to believe that a change in the propulsion system from internal combustion engines to electric motors should have a pronounced impact on market competition or on the total industry valuation of the company. So I guess that's a big question. Are these companies going to be able to be that much more efficient that they will deserve premium multiples? And I mean, I guess the jury is out. It's too early to know.
Right now, we're in an environment where investors are willing to give these companies a benefit of the doubt. It is. I do take issue with the fact that they say it's not that much different. Like
it seems pretty different, right?
Tesla has a huge iPad in the car, and if they have an update, they do a software update overnight or something. That's a huge difference.
Yeah.
Are people still going to pay that much more for it in the future? I don't know, but does it kind of make sense that it is different? It is different.
So, all right, over the weekend, Kathy Wood and the ARC team put out their projections for Tesla going out to 2025. They gave a bear case, a bull case, and a base case.
Don't you think they may give like a bull case and then a double bull case?
I think stuff like this is why people scoff and don't take them as serious research analysts, because their base case is, what are the numbers? $3 trillion in 4 years. No, I'm sorry. Their base case is their bear case is $1.4 trillion. And I think the bull is 3, the base is 3, the bull case is 4 trillion. I mean, this isn't serious, right? Is it? Come on, this is not serious. Unless literally they're the visionaries and we're morons, which very might well be the case, that the electric vehicle industry completely changes the dynamics of competition and the dynamics of everything. Like, maybe is the world, but you see something like this and you just shake your head and say, this isn't serious. This is not serious.
To their credit, they put their models for everyone to see.
Yes.
You can see exactly what their inputs are, what their outputs are. They said they use 34 inputs and they have all these forecasts. So you can go through, and if you really knew this space, you could say, no, this doesn't make sense. What are they using this for?
But so what? That pisses people off. How about a little humility? How about saying, hey, we could be wrong? How is their bear case $1.4 trillion? There's no sense of humility. Like,
okay, back to the Dalio thing. This is marketing.
This is marketing.
How many people have talked about this? This is part marketing. And the other thing, back to like Kathy Wood versus Rob Arnott in terms of.
But don't you see why a report like this pisses people off?
I can see the other part of it is, will people still be willing to put a premium on their price in the future? That's what's so hard about these things, and it's obviously it's all garbage in, garbage out. To be fair, people said the same thing last time. I don't know. Do you have to?
So what?
Yeah, I'm not trying to give her the benefit. Okay,
so
all right. I agree. You're right. It's weird to have a bear case that's higher than the price is today.
I think this is why people are mad about the Tesla thing. It's like Tesla bulls have been bailed out by price, but the fundamental story hasn't changed. And I don't know the fundamental story. I guess I can't believe that it hasn't changed a little bit. I mean, that they're obviously doing some things right, but man, a base case of 1.4 trillion. I'm sorry, I keep mixing this up. A bear case of $1.4 trillion. Ben, there's only 3 companies in the world with a $1.4 trillion market cap. I mean, come on. That's not serious.
By 2025, there'll be like $1 trillion company on every street corner, right?
Yeah.
I get it. They've had some great calls in the past. And so the problem is, it's like, okay, do we give them the benefit of the doubt here, or are they just overconfident now and they're really going for it and they're way out over their skis? So that's like what you're trying to figure out as an investor.
But yeah, but I think like the whole "well, they were right last time" thing should have no relevance, or maybe not that much relevance in their views going forward.